Hello everyone, nice to see you, and today we will continue our lectures, and today we will have our fourth lecture in our course Performance Management, and today we will start a block of materials that is called Financial Performance Management. Financial Performance Management, and today we will start part one of our blog connected with financial performance management, and we will discuss the questions connected with modern trends and important implications of financial performance management. And then we will continue. Next time we will continue, and we will start part two connected with financial performance evaluation. Okay, in order to start, before the start, please write me in the chat. Can you see me? Can you hear me? Can you see the screen? Is everything okay? Please write me in the chat. Okay, thank you. Good morning. Thank you very much. Okay, let's start. And let's start with my questions. Before we start our blog connected with the financial performance management and financial performance evaluation, could you write me in the chat? Have you studied yet in your previous courses financial analysis, and what financial indicators do you remember from your previous courses? What financial indicators do you know? Do you remember? What financial indicators could you use in order to evaluate the financial performance of any enterprise? Return on equity, okay. And what else? What indicators do you remember? Maybe liquidity ratios, financial leverage, financial leverages. Okay, so thank you very much. I think you remember something, and of course we will recall when we are starting the part connected with financial performance evaluation. Of course, I'll make a brief review of these financial performance indicators, so we will record current ratio of liquidity. Okay, thank you very much. And of course, during our tutorials, during our practice work, of course, we will recall all these indicators. Okay, and today our task is to analyze modern trends and important implications of financial performance management that influence on the modern financial performance, on the performance management framework. So part one is called Financial Performance Management, Modern Trends and Important Implications. Main ideas of the modern financial performance indicators and modern trends. I highlighted the two, in my opinion, most important. First one is that maximizing shareholder wealth creation is becoming a result, and earlier we considered that there's a goal of any enterprises, and maximizing shareholder wealth creation is a result of improving performance, and we could improve performance of our enterprise by integrating and by using different kind of tools, for example, balanced scorecard model and financial performance evaluation and lean management, cost management, Six Sigma model, total quality management, project management, and so on. Second one, financial reporting based on after the fact events is important, but is much different from the application of internal managerial or management accounting. And we use management accounting or managerial accounting in order to make the decisions, managerial decisions, in order to support the process of making decisions. and these decisions are connected with value creation. And let me ask you, do you know the difference between managerial or management accounting and financial accounting? And what do you think about this difference? What is the difference between the managerial accounting and financial accounting? Could you write in the chat your opinions, your ideas about the main differences between this type of accounting? Managerial accounting for internal control, financial, external. Okay, thank you. Thank you. Correct idea. Yes, financial accounting is based mostly on rules and norms, and these rules and norms are established by external users, government, or tax committees, and so on. Another ideas, maybe you have another ideas, and you can share it with us. So the key idea is clear that managerial accounting is something internal, our internal actions, and managerial accounting is based on our rules, internal rules, that our corporation, our enterprise is establishes, and financial accounting uses rules established by external users mostly. Okay, and what do you think? Which type of accounting is more important? And could we say that managerial accounting is more important, or financial accounting is more important, or and could you write me in the chat? What do you think, in your opinion? Could we say that managerial accounting is more important, or maybe okay. Carlos, hi Carlos. Carlos is our colleague. Hello, hello. Nice to see you. Nice to see you. Join us. I'm glad to see you. Thank you very much. I think both are equally important. Okay, both are equally important. Of course, both are equally important, and managerial accounting and financial accounting plays its own role. And as our colleague from United States, Gary Cookings, consider financial reporting is a result. Financial reporting is a result, and managerial accounting helps create this result. So, and do you agree with this opinion that financial reporting, financial accounting is a result, and managerial accounting helps create this result? So today, after we will have after lecture, we will have we will watch the video from Gary Cookings, and we will analyze this phrase again. I think both are equally important. Probably that's true. Okay, thank you very much. And according to the Gary Cookings opinions, managerial accounting is part of participates managerial accounting participates in forming leadership to reinforce the executive team's messages. Also, managerial accounting, managing accounting is a part of risk and strategy management and execution. And then the role of managerial accounting is to facilitate an organizational um, improvement, learning improvement, including cross-functional collaboration, communication, and so on. So, of course, managerial accounting plays its role, and of course, financial accounting plays its important role. Thank you very much. Thank you. Okay. The main idea of the managerial accounting is to support the process of making decisions and to help create to create value and to participate in this process of value creation. And the managerial accounting participates in both directions, in cost analysis and in decision support. What does it mean? We use the principles of managerial accounting in cost analysis, and we use different types of cost analysis in order to analyze our historical data. And this is the following. These are the following types of analysis: cost variance analysis, and we deal with types of analysis during our tutorials: activity cost analysis, benchmarking, performance measure monitoring. And these types of analysis are based on our historical information. Regarding decision support, and we understand that decision support is based on our future projections, and we use the following types of analysis. We use profit margin analysis, price analysis, then project evaluation, cost analysis, incremental cost analysis, marginal cost analysis, and so on. And we are based, this analysis is based on our future data, future projections. So we are making assumptions and projections, and we make appropriate calculations in order to create some information in order to support our process of making decisions. Okay, and one of the modern trend in managerial accounting, in financial performance management, is a use of activity-based cost principles. And this kind of cost management based on activity-based cost principles is becoming more popular recently, and experts consider that it's because of complexity of business and complexity of manufacturing. The goal of this kind of analysis, this kind of cost management, is to apply cost, direct cost, to whatever consumes resources. So the main idea of this type of cost management is to identify the drivers, our activities that are important drivers, and to distribute our costs according to the measurable drivers. And let's compare our standard costing system and activity-based cost management principles. So on this figure, you can see the recent trends connected with the growing overheads. So indirect expenses are growing recently in business, in enterprises. And it means that we should use some other ideas in order to account these indirect expenses. And that's why activity-based cost management is becoming popular. If earlier, based on standard costing system, we consider this overhead indirect expenses fixed. Nowadays, we use and corporations, enterprises use ABC, activity-based cost analysis, in order to reallocate overhead according to the business processes connected with these overheads. So let's recall the main ideas of the standard costing system in order to compare the standard costing system and the managerial accounting. The standard costing, so we estimate expenses of our production process. And we use the standard costing as a part of our cost accounting. And the main idea of the standard costing is to identify expenses such as direct material, direct labor expenses, overhead. And we use the variance analysis in order to compare our actual costs and so-called standard cost or planned budgeted cost. So we made the variance analysis on our tutorials, so you know what it looks like. And the main advantages of the standard costing are the following: efficiency, so allows for cost control, help us to make the decisions, help us to prepare budgets, help us to make our production costs lower. But we can identify the following disadvantages: low feedback, because our variance reports are prepared monthly as a rule. Then some behavioral aspects. Sometimes our employees become demotivated because most managers tend to focus on problem areas rather than success. And using this standard costing system, they could be top managers, they could be spending more time rectifying any variances than congratulating our employees for a job well done. So employee backlash. So what I mean, because of demotivation, employees could potentially, not always, but sometimes, could hide any unfavorable variances to avoid any future negative effects. And let's recall the standard cost and the principles of standard cost. And let's look at the simple example, simple case, and let's try to calculate the standard cost for production using this information. So let's imagine that we have the following information: standard quantity, 20 pounds per unit, direct materials price, direct labor rate, direct labor standard hours per unit, and the overhead. And please try to calculate the standard cost for production. I give you some minutes, and you may write your answers in the chat. Please write your answers in the chat, and then we will return to my presentation, then we will check your answers, okay? So let's try calculate the figure of standard cost for production in order to recall something from standard costing. And please write your answers in the chat. So let's recall that in order to get this standard cost for production, we should calculate direct material costs, direct labor costs, overheads. Have you calculated and have you got the result? So please write me in the chat your ideas, your figures. So it's very simple calculations because we have standard quantity. So in order to calculate the standard cost for direct materials, we should multiply standard quantity by direct material price. Okay, so we have got the result. Thank you, Anastasia. Of course, correct answer, 400. So let's look at the presentation slide with the answer. So it's very simple calculations. So direct material standard cost is 200, then 150 direct labor standard cost and 50 overhead. And the sum of these figures is the standard cost for the production. Modern trends is connected with the use of activity-based cost management or activity-based budgeting. And we have discussed a little bit on our previous lectures the main principle of different types of budgeting system and activity-based budgeting. The main idea is that we are identifying the activities that underlie the financial figures in each function and using the level of activity to decide. So you can see on my slide the main definition of this activity-based budgeting activity to decide how much resource should be allocated and how well it's being managed, and to explain variances from budget. So our main task is to identify the drivers, main drivers of our important business processes. And on my next slide, you can see the main principles of ABC cost management or ABC budgeting system. So the principle number one that implies that it's activities which drive cost, and the aim is to plan and control the causes, so drivers, so-called drivers of costs rather than costs themselves. The principle number two, second principle, not all activities add value. So we should identify the most important activities, the most important business processes that are participating in value creation. The third one, most departmental activities are driven by demands and decisions beyond the immediate control of the manager responsible for the department's budget. So we should identify these drivers, cost drivers, taking account this third principle. So most departmental activities are driven by demands and decisions beyond the immediate control of the manager responsible for the department's budget. And the fourth one principle is the following: traditional financial measures of performance are unable to fulfill the objective of continuous improvement. So we should use the additional measures which focus on drivers of costs. Let's look at the example in order to understand the main idea of the activity-based budget, activity-based cost management principles. So let's look at these small case. Let's imagine the production department. And this production department has four major activities: receiving deliveries, material handling, production runs, quality tests. So these are main drivers, and we have identified it before. Each of these activities has an identifiable cost driver, and we have some figures, estimated volumes for the coming period for each activity. Apart from these activities, we have two other activities that occur in the department, and these are administration and supervision. And what we know, these activities are non-volume related. They are necessary functions and shouldn't be ignored in the budgeting process. Below, we have some figures connected with costs: management salary, basic wages, overtime, factory overheads, other costs. And we have some figures related to the activities. So we have some figures, for example, overtime. We know that the total cost of overtime 15, and for receiving deliveries is 6. For quality tests activities $1, and production runs is 8. What is required in this small case? It's required to find the total cost for each activity, then to calculate total cost for the production department, and to identify cost per activity unit. Let's look at the results. It is the preliminary result. In the table format, we can present all the information about the activities. So receiving deliveries, material handling, production runs, quality tests. We use the volume form. We know these figures, volume for each activity. And you can see that we can see the information about the costs according to the actions, the drivers, the activities. And we can see also the figures, the total figures for each drivers, for each activities, and total costs. And let's let's calculate what's required in our third part, cost per activity unit. So based on this information, let's calculate, for example, cost per activity unit using the activity connected with receiving deliveries. So let's try to calculate, and please make this calculation. And using the chat, please give me your answer. Let's try to calculate using these figures. So we have the total costs, and we have figures for each type of costs, and we have calculated these costs for each activity. So we have 4 activities: receiving deliveries, material handling, production runs, quality tests. So let's do it for receiving deliveries. Let's calculate the cost per unit using these figures, and give me your answer using by chat, and let's check together. If you have calculated and if you have got the figure, please write me in the chat your idea, your answer, and let's check. So what should we do? We should divide the total sum of costs per activity, and now we are working with receiving deliveries, by the volume. And please pay attention that our total costs are given in thousands. So we have 17,000, and we have to divide 17,000 by volume. Volume means number of deliveries. So the right answer is approximately 56.7 or 0.66. So this is the right answer. And let's check. So the same we should do for other activities for material handling and for production runs, for quality tests, we should use the total costs figures for irrelevant activities, and we should divide this figure by volume, number of movements on material, or number of production runs, or number of quality tests. And in this way, we could calculate and we could get the cost per activity unit. And what's going on with the reporting system? Is it changing? Yes, of course it's changing. And when we are looking at our chart of accounts view, first one with the variances, with variances, so we can see the figure for actual figures, plan figures, favorable, unfavorable, it's variance analysis. It is usual form for this chart of accounts view. Usual form for actual plan analysis. It's a good report, it's a correct report, but if we are talking about the activity-based costing, the vision and the form of presenting our figures is changing a little bit. So on the right, we can see the activity-based view. So we have a list of our drivers and the costs connected with these drivers. So the total figures for total costs is the same, but we are analyzing the cost drivers mostly, and we are analyzing the causes of our costs mostly, not the costs themselves. And the idea is the following. We do not manage the costs. We do not manage the costs. We do manage the processes, business processes connected with these costs. So this is the idea of activity-based cost management. And another vision, another scheme presented this idea, activity-based cost management. So we use different types of resources in our production, in our enterprise. So direct materials, salary, depreciation, communication, so on. So different types of resources. And these different types of resources are used in different types of activities, work activities, activities connected with human resources. And also these types of resources are used in different channels, connected with our suppliers, connected with services, our customers, and so on. So we can use another vision in order to define the allocation of our resources. And another scheme, another picture allows us to compare traditional view on traditional costing, on standard costing view, and activity-based management view, vision of these cost allocations. So traditional costing implies that resources are allocated to cost objects. So this is traditional costing. And if we use ABC system, I mean activity-based cost management, we use another ideology. So different types of resources are consumed by activities, and these activities are consumed by cost objects. So this is the idea. So the idea is we do not manage the costs, we do manage the processes. And the wide vision of activity-based management or activity-based cost management, resources are consumed by activities, and activities are connected with different channels, and the cost objects are connected with these different channels, products, customers, and different types of business processes. This is expanded activity-based management model. And also another modern trend in financial performance management is connected with the appearance of lean management ideas, lean management principles. And let's look at my slides connected with lean management principles, and let's try to understand the idea of lean management. It looks like a philosophy. It is approach to identifying and eliminating waste, including non-value adding activities. What does it mean in terms of cost management? In order to account the costs using the lean management principles, we use the value stream mapping. On this map, we can present our business processes connected with our enterprise activities, and we can present the costs connected with these business processes, different types of business processes, and we can present our costs in terms of value added, non-value added costs. For example, we use the principles of Six Sigma, lean management, and value stream mapping in order to present our enterprise activities in terms of different business processes, cost drivers, and different types of costs participated in these business processes, and we can identify costs connected with value creation and non-value added costs. Non-value added costs. So another vision of costs. So it is so-called value stream map. If we are looking at this value stream map, we can see different stacks connected with costs, and each stack's height reflects the amount of resource expenses consumed, such as wages, supplies, and energy, and each cost stack can be measured in monetary terms. So we can use different types of measures for each value stream: safety, quality, time, delivery, and of course costs. And the main principles of cost accounting and lean management, and you can see on my slide these important principles. Lean accounting uses a method that identifies costs by value stream, so-called costs or resources allocated in different types of business processes. And we use this term value stream rather than, and we use this principle, allocation of different types of cost by value stream rather than by department. Another principle of cost accounting and lean management: costs calculated quickly. Another one, no distinction made between direct or indirect costs. So we do not identify direct or indirect costs. All costs of the value stream are considered direct. Then value stream costs include labor, materials, production support, machines, equipment, operation support, facilities, and maintenance. Then next one, value stream costing provides more accurate picture by elimination unnecessary costs outside control of value stream managers. So another principle of accounting. And next one, lean accounting groups together costs that fall outside of the value stream as business sustaining costs that do not get included in value stream costs. And if you are interested in lean management and getting details, I recommend you to find some materials about lean management and lean and cost accounting in lean management by using the following link. You can see on my slide, following link. It is the link we allocated some, and you can find there some materials about lean management. And yes, it's modern practice, modern trends in performance management, and of course it's very interesting. But for me, it looks now it looks like philosophy more than concrete management practice. But in some ways, of course, it makes sense. It makes sense to take into account, pay attention to these lean management principles, of course. And what are we going to do next? So, our next part of our lecture will be connected with the video from Gary Cookins. We continue working with this video about analytics-based performance management. And our task will be connected with this video, and we have to watch the part of the video connected with the cost management practice in performance management framework. And you have to listen to Gary Cookins' speech. On my slide, you can see the details of our task. So you have to watch the video, the part starting at 21st minute till 30. And based on this video and based on our lecture materials, please make the following task. So define the main limitations of the traditional approach to cost management discussed in this part and discussed in our lecture. So Today, we have analyzed the principles of cost management and the principles of activity-based cost management. And we have compared these systems, we have compared, and we have defined some limitations of standard costing and activity-based cost management. And please define the sense of this phrase. What does this phrase mean? You do not really manage your cost, but rather you manage what causes your cost to occur. And the source of this phrase is Gary Cookins and his work, Performance Management, Integrating Strategy, Execution, Methodologies, Risk and Analytics. And you may find the link to this book in our course description, in our course program, because I use this book. And you can find it in our library. And please work individually on this task, and please do not forget and attach your works in LMS as individual project. And I have created your project, this project for you in LMS. And some words about our deadlines and our future plans. So please do not forget that today you have the deadline for the first part of your home task, your group homework. Please send me via email your cases connected with your own cases, cases with solutions. In order we could check these cases and we could put your cases for further works in LMS. Okay, so when I collect all your cases, I inform you about our further actions. Okay, I remind you our further actions. Could you please write the task here? Of course, Marina, thank you very much. You just in case, you can see all these materials. You can see the presentation and the feedback task, connected with this lecture, feedback task. You can see it, you can find it in LMS. I've put all these materials in LMS in the folder files, and you can find it there. And of course, I'm sending this task in the chat. So okay, so I've sent you the task in the chat. So please listen to Gary Cookins' speech about the practice of performance management starting at 21st minute till 30. Based on this video and lecture materials, please make the following task. Please define the main limitations of the traditional approach to cost management discussed in this part. And what does this phrase mean? You don't really manage your cost, but rather you manage what causes your cost to occur. And please work individually and attach your works in LMS as individual projects. So the video lasts approximately 10 minutes, and then I give you rest time till the end of our class in order you could write your opinion in the form of small essay, several sentences. I think 4 or 5 sentences will be enough. And please work individually and attach your works in LMS as individual project. I have created this project. If you have any questions, please write me in the chat or by email. I'm here. I'm going to turn on the video on my computer. So you can watch this video with me, or you can watch this video separately using your facilities, using your computer as you want. So please free to both questions based on the video. Yes, of course, both questions based on the video, and of course these both questions based on our materials and our lecture. So both video are based on both questions are based on the video and based on our topic of today lecture. So you may use a video, of course, and you may use our lecture materials. So I'm here. I'm going to turn on the video on my computer, so you can watch this video with me using the translation on our main translation, or you may use your facilities, your gadgets, your notebooks. Thank you very much for being here, and let's start watching.
Trust of the management accounting system and its flawed cost allocations and misleading cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. Occasionally someone in the audience will say, I think there's a typo there. You've got cost allocations. You meant misallocations, because it's being misallocated. I'm being charged by the accountants for this thing. I nothing to do with it, but those two departments over there are causing all of it. But the accountants are allocated.
Excuse me, I'd like to ask you, do you see the screen? Do you hear the translation of the video? Because I'm turning on the video on my computer, and I'd like to check the sound, check the video. Could you write me in the chat? Okay, so I turn on again.
It on some factor like labor input hours that's got nothing to do with me. So that really is started to what lead to Kaplan's interest in activity-based costing. And part of it was because indirect expenses was beginning and is continuing to be much larger relative to direct expenses. And this is because companies have so much diversity and variation of outputs, colors, sizes, ranges compared to what it was in the 1950s. White refrigerators or black refrigerators, that's all you got. Now you got 100 colors. It creates complexity. Complexity calls more indirect. That indirect has got to be traced. So the simplest way to understand ABC is this little story. Imagine you go to a restaurant with 3 other friends. You order a little salad, and the other 3 order the most expensive item on the menu and a glass of wine. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products feel In a standard cost accounting system from a general ledger, when the accountants take this large single blob of indirect expense, commonly called overhead, and allocate it on these broad-brushed averages like direct labor input hours, machine hours, number of units produced, sales dollars, square feet, it does not reflect the unique consumption of the individual end-to-end processes of these products and the activities that belong to them. So if you trace the consumption relationship proportionally, you discover some of those products are overcosted and the others must be undercosted because it's a zero-sum error game. It may reconcile on the total and satisfy the auditors, but in the parts it's totally misleading. You've got people doing profit margin analysis and all sorts of strategic decisions. It's flawed, it's misleading. So the simple definition of ABC is as if the waiter or waitress brings four individual checks. You pay for what you consume. Now, the problem actually begins with this traditional cost center responsibility center statement. I can tell you every manager on the planet Earth recognizes this. But when they receive it, they ask themselves, how much insight and understanding do I get? It just shows me what I spent. I don't know what caused me to have more or less. I usually say when managers receive this kind of report, they are either happy or sad. They are rarely any smarter. The problem is not the report, it's a good report. The problem is the data in this format is not structured in a way that you can produce make them smarter. So all that activity-based costing does is it takes that same $914,000 of what we spent, it translates it into the language of work, ideally with a verb-noun grammar, and then it reassigns the work cost into the products or customers just like the waiter or waitress with the individual checks. Notice I'm using the back office of an insurance company. It's a factory too. Don't think that this ABC thing is some manufacturing thing. It's pretty universal. When employees actually experience this, they go get an aha moment. They usually used to think that spending began on the left. The spending actually begins at the right side of this diagram. The products and customers place demands on the workload to the left. The workload then draws on the capacity or spending, and then the costs measure the effect in the other direction. So demands on work flow right to left. Costs are a measure of effect. It's a principle. Rules are many, principles are few, like speed of light and gravity. This is a principle. Unfortunately, many of the accountants violate it when they do these allocations. We'll talk about that. Now, I've twisted this, I've rotated it 90 degrees. It isn't as simple as ledger expenses go to activities, then we assign them to cost objects. The right side is more realistic. It's multi-stage. You have support departments that do work for other support departments that ultimately support the frontline departments that interact with customers or make products. So it has to be multiple stage. And then I'm going to take a risk here. I'm going to take you into a little more detailed slide, but I can't spend much time on it. You can go to my website. And I'm retired. I didn't finish that. I'm kind of like semi-retired. My grandsons are 12 and 16 now, and one just got his driver's license, and I retired from SAS 3 years ago. I'm kind of having fun, and this is fun. But I still like teaching, and so this is a decomposition of the previous diagram very quickly. It has the three universal components of any organization's expense structure. You've got the resources at the top, you got the work activities in the middle, and they will eventually pile up into the products of the customers. You have to adjust your thinking. This is not a flow chart with swim lanes. It's reassigning the same amount of money. So if you start with, let's say, $20 million of January expenses, you will have $20 million of activities, and the $20 million will pile up in that bottom right box, customers, and something we call business sustaining. Think of those arrows you see as thin straws or wide pipes where the diameter reflects the amount of money that's going through. And in your mind, reverse the arrows the opposite direction. If you could do that, imagine the arrows are now going from bottom to top. That's what's happening in any organization every minute, hour, day, week, month, year. The products and the customers are placing demands on the workload's drawing on the spending and capacity. The costs measure the effect in the other direction. The point here is this: costing is modeling. It is not T accounts and journal entries and debits and credits. You model the expenses into calculated costs. But what's much more important is, what does one see after you do all that piping? This is the classic called the profit cliff. Many call it the humpback whale because it looks like a humpback whale. This is real data that you're looking at. This is a chair company with 850 products on the horizontal axis. The vertical axis is the net revenues minus the properly traced and calculated cost using ABC. The horizontal axis is the cumulative buildup of the profit by product, but it's rank order from the most profitable product to the next most profitable product and so forth. Eventually, you get to break even, and you'll notice to the right, then you've got unprofitable products. And it's always a shock when management sees this graph, because in this particular case, what they saw is it said, look, you made roughly $8 million of unrealized profits on 3/4 of your most profitable products. You lost $6 million on the remainder to net out at 2, and that last 2 data point reconciles exactly with the P&L. And their belief system before seeing this graph is that curve looked like this little anthill with a hook on the end. And what was happening is all that broad-brushed averaging, splitting the check 4 ways, was crushing and suppressing all of the detection of diversity and variation of which product and all these handling moves and stuff. And it was basically then showing the true picture, not this false picture at the bottom. Now, some of you may be saying, well, what am I supposed to react to? Do I drop the products that are the losers? No, that could be a big mistake. In many cases, organizations will sell losing items with positive items, so they couple them together. Also, quite frankly, cost accounting does not do a good job on product life cycles. It does period costing, January, February, but it doesn't focus it on a single product. So if you have a new product that's just been released, it may not have sales volume, and it's in a shakeout period with extra expense. But each time you take the snapshot, it would basically start migrating to the positive side. But at least it's fact-based data. At least it's fact-based data. Because remember this, especially for you younger people, in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. And usually the biggest opinion wins, which is the opinion of your boss or the boss of your boss. So to the degree they are making decisions on gut feel or intuition or flawed and misleading data, your organization's at risk. Let's move on. Strategy, the 5th force, the move from being product-centric to customer-centric. As an example, you go to the 5 banks up in Toronto, major banks, the way Canada's organized, they've all shifted from product managers, deposits, automobile loans, to customer managers, customer-centric, because a customer could buy any of those products. And as I mentioned earlier, customers are viewing suppliers as commodities, so we really need to basically be thinking differently. The only value a company will ever create is the value that comes from its customers, the current customers and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we have a couple of problems. Most organizations don't know what the profitability of a customer is. They stop at the product line, so they don't even know how to basically make the comparison. We have another problem. Sales and marketing people pretty much have 2 goals: grow market share and grow sales. But when we saw that profit cliff, we need to have them grow profitable sales. The problem is there's a big wide gap between the CFO and the marketing and sales people. There's also a gap between operations, but the operations people are doing pretty well. They have lean management, Six Sigma, and other these process improvement tools. The real issue is strategy. And so somehow we have to close this gap between the finance and accounting function and sales and marketing. Products and standard service lines are not the only thing which accountants should compute costs for. What about all the costs that have nothing to do with making products and delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. And I'm making a case that this bottom half is more important. The top half is on the line, product gross profit. Below that line, selling,
distribution, marketing, customer service.
Okay, so I'm turn off the video. And please 10 minutes left, and in the rest time, please fulfill this task. So based on the video, based on our lecture, prepare your answer about the main limitations of the traditional approach to cost management discussed in this part in this video in our lecture, and prepare your opinion about the phase. You don't really manage your cost, but rather you manage what causes your cost to occur. And please attach your works in LMS as individual projects, and I've created. If you have any questions, please feel free to ask. I'm here, so I'm waiting for your questions. If you have one, I'm waiting also your group home task, first part of your home task. And thank you for being here. Have a good time. And 8 minutes left, and please finish your works and attach your files in LMS. And also I'd like to tell you that all these records, all the records of our lectures, you can find in LMS in the special folder records. So you can use it for your works, for the preparation, for the tutorials and so on. So if you have any questions, please let me know. I'll have a good time. Hello, Carlos, how are you? How are you?
Good, how are you?
Thank you very much for being here, for participation. Thank you. Okay,
Thank you.
so we are going to check together the home tasks. So I'm waiting for home task from our students, and then I'll write you and I'll write Yelena. I'll send you some works so we can work together finally.
Perfect, perfect. Looking forward to it.
How are you? How is your doing? How is your studying? You are studying online, full online, yes?
Yes, we're all online now, and I've been in Peter, so I don't mind. It's good all
That's
this
good.
time.
Okay, and
Yeah.
where are you from? From what country? Where are you from?
Colombia. I'm from
Oh,
Colombia.
Colombia. So, oh, okay. So I can
Uh,
practice my Spanish because I speak Spain a little bit.
Claro,
So, yes. So we
that
can
is
we
nice.
can
I
speak
can practice
a
my
little
Russian
bit.
too.
Yes. Okay. Yes, I have friends from Colombia, from Bogota. So I'm.
Yes, yes.
Mhm.
I went to Universidad de los Andes, is the
Mhm.
top university in economics in Bogota.
In Bogota. Okay.
Yeah.
Okay.
Although I'm from the coast, I'm from Barranquilla, from the Caribbean.
Oh,
So
I know this. It's on the beach, near the
yes, yes,
ocean. Okay, so
yes. But I studied in
good
Bogota
place.
all the time. Yes.
Okay, thank you very much.
Yeah.
So it's a pleasure to work with you. So we can speak
The pleasure
Spain.
is all mine. It's all mine.
Thank you very much. So I think it will be very fun to work with
Yes,
our students and to work together.
yes.
Thank you, and have a good time. Have a good weekend. Mhm.
Same to you. Thank you.
Thank you very much. Thank you. Bye
That's it.
bye, and see you, see you. So you are
Okay.
welcome to our classes if you are interested. If it's interesting for you, okay,
Yes, of course.
of
Of
course.
course. I'll sneak in.
Okay. See you. See you.
See ya.
Mhm.